Holy smokes, we got to talk about the consumer because the consumer is not running out of cash the way you think. Last year, we were told by the big banks like JP Morgan that, people are going through their savings and they're running out of excess savings. You will not believe the latest data that JP Morgan is giving us on the actual bank balances that people have. It is absolutely insane, and it should affect the way that you invest. Not personalized financial advice for you, but you should look at that and go, damn, I didn't realize that. It's nutty. So let's talk about that and what that potentially means for a 6% terminal federal funds rate from the Federal Reserve. Anyway, let's get started right after, of course, I have to mention 69% off flash sale. Not only on the shadowing experience, but all the programs on building your wealth, whether it's stocks, the psychology of money, real estate investing, 0 to millionaire. Start with your first home, first rental property, second rental property. Then you want to go into managing property yourself or renovating better, do-it-yourself property management, rental renovations. And then, of course, you've got the Elite Hustlers course, YouTube, and real estate agent course where we get together and try to help you increase your income so you have more of an income to invest. Of course, you could use that flash sale on the shadowing experience as well. Okay, let's get into consumer health. JP Morgan report. Information from bank and credit card CEOs shows that cash balances, both checking and savings, remain elevated to pre-COVID levels. Now, you're going to see exactly by how much in just a moment, and it's insane. Additionally, this cash pile has been declining at a slower than expected rate. In other words, CEOs thought we were going to burn through excess cash faster than we actually are. That means people end up having more money to support company earnings. Consumers are holding less credit debt and are paying bills at a higher rate than before the pandemic. How insane is that? Because in November, December, we saw these insane credit spikes of people like taking on way more debt. In October as well. Debt accrual actually declined in January. We didn't take on as much debt in January. But at the end of the year, people were going crazy into debt. More personal loans. It was a big boon for SoFi and Upstart. They killed it with personal loans. Upstart had a fantastic report yesterday. They were up, They were up 28% yesterday. Today in pre-market, they're giving back like 6%, but who cares? They're up like 28% yesterday. It's absolutely insane. And so you've got consumers borrowing like crazy right now. But listen to this. Combining this information, JP Morgan is telling us fears of a consumer-led recession in 2023 appear overblown, absent a black swan event. In their words, exogenous shock, whatever. Under this hypothesis, the earliest a recession would materialize is mid-2024. That actually aligns with the inverted yield curve, which says the recession could be delayed to 2024, right? Now, there's this talk about maybe oversimplifying the market, though, by talking about hard landing versus soft landing versus no landing. And JP Morgan's basically like, dude, we have no freaking idea what this plane is doing. And quite frankly, the economy's not really a plane anyway, because who says it has to land and who says it's going to run out of gas? Like, maybe that's just not the best analogy. But anyway, one of their co-heads of global equity trading says the following, and I think it's honestly probably one of the most honest perspectives I've seen right here, not because I think it sort of reiterates what I'm doing, but because they start off with, I don't know. I think that's just honest, right? And so he says, I don't know what this print changes, talking about the CPI numbers. So everyone I talk to is saying people are long and we should sell rallies. And it's hard to disagree with that. But every time people sell the rallies this year, it's been wrong. I think this year is shaping up to be buy dips and the 60-40 portfolio is back with short duration treasuries. I actually thought that was a very honest suggestion for people. That, hey man, look, like so far selling the rips has been a mistake. Maybe any dip, buy it. And I'm not saying I respect this because it aligns with me. I think that's convenient, but I respect it because I think he's honest. Like, dude, so far selling the rips has been a bad idea because it just keeps going higher. But I think what he's saying very much aligns with the Nike swoosh thesis. Although I don't want to be subject to confirmation bias, although even being aware of your own potential confirmation bias doesn't necessarily remove your confirmation bias. Anyway, so look at this, folks. Look at this chart from Bloomberg Opinion here. Household savings exploded higher during the pandemic, causing havoc in the labor market. Look at this explosion. This is insane. But you ready for the real bombshell? 69% off on the coupon. It's a flash sale, it's not a coupon. Sorry, I had to do it. Look at this. Okay, wait, where is it? Credit card balances as a percentage of disposable income are less than they were pre-pandemic. Also true. So here it is, folks. This is the bombshell. Ready? Here we go. Wells Fargo, who highlighted spend data, is still very healthy. And debit card spending is up 3% year over year in January and accelerated 1% year over year in December, with card spending tracking 20% up in January. This is like the American Express report, basically saying people are spending through this recession, right? Listen to this. Consumers with $2,000 to $5,000 in their savings account pre-pandemic, okay? I need you to really listen to that because I don't think you listened to that, and that's okay. Consumers before the pandemic had on average $2,000 to $5,000 in their savings account, okay? I'm drawing that on the screen. $2,000 to $5,000, okay? This is a really important note I want you to pay attention to, okay? $2,000 to $5,000 pre-pandemic. What do they have now? $12.8 thousand currently. And this balance has been stable for the past few months after peaking at 13.4% in April 2022 per Bank of America. Holy crap. When I read this yesterday while we were traveling with members or with my team members, a research team, I'm looking at this and I'm like, good Lord. You're telling me excess savings, which everybody's been talking about falling, has only fallen from $13.4 thousand in April, basically a year ago, to 12.8 now. You realize 12.8 divided by 13.4 only means consumers have drawn down 4.5% of their excess savings. And it is still over 2.5x the upper end of excess savings we had before the pandemic. Consumers, again, with $2,500 in their savings account before the pandemic are now sitting at $12.8 thousand. That's a freaking bombshell. That's a bombshell. No wonder we potentially could see some form of inflationary impulses because this is insane. On top of that, you do still have JP Morgan warning about potentially you could see earnings pockets. People are spending less on gas. That's great. Cars are more efficient. You've got people saying, hey, the Fed's going to end up crimping us. But despite that, what did you end up getting with retail sales yesterday? Reiterating that they're way up. People are spending way more than expected. The Atlanta Fed GDP Now estimate shows what are we at now? 2.4% on GDP Now. GDP Now, by the way, basically takes all of the latest data and they try to forecast what they think GDP is going to be for the nation using the latest economic data, right? So they try to update it all the time. But anyway, they're adjusting that GDP up for 2023. It does not look like we're walking into a recession in 2023. People have way too much freaking money. Way more money than we expected. And GDP is moving up. Now, that does reiterate the higher for longer narrative, right? And this is why you get people saying, hey, look, there's a reason people are talking about the 6% terminal Fed funds rate, right? And here, for example, I think this is a Goldman Sachs piece. They're basically talking about we probably have to see further data. But if 6% terminal narratives become more widely adopted, we could be in for a bout of equity weakness. But then again, as we recently, and it's worth noting, we recently went from 4.9% on a Fed terminal rate to 5.3% on market expectations. And even though we had a bumpy equity markets trended up. Very important to consider. So pretty crazy. Now, I want to be very clear. If you support me and you want to shadow me in a day, Some of the days we can't guarantee that we're going to be traveling. Some of the days we're going to be driving, and we'll go look at real estate. Some of the days we might might be in office days. So it's just very important. Most of our shadows, that doesn't so much matter, but the point is, I just want to be very, very clear. Anytime that I mention the shadowing experience, very clear that there's no transportation that's guaranteed. You're not coming here to book transportation. You're coming to shadow me, whatever it is that I'm doing with my businesses. So I want to make that very, very clear. And you could use that flash sale for 69% off expiring Friday. And this is some pretty crazy data that we're getting here on the consumer spend, but it reiterates no recession this year. That is pretty remarkable.